Hello, my name is Jeff McTague, and welcome. For those of you who missed the last session, let me get you caught up. I've been in the financial services industry for 35 years, spending most of my career as a wholesaler. One day in 1997, I asked, how do investors choose their financial advisor? It boiled down to two very arbitrary and subjective reasons. The client either one, liked you, or two, trusted you. I felt if I could develop a client presentation completely supported by fact, and if you adopted that presentation, I knew you would gain a serious upper hand in the competition for clients. In short, that is just what I did, and by 1998, my business, Active Fund Strategies, was born. The hub of my business is the $17 trillion mutual fund industry. And to develop this fact-based presentation, my first focus was mutual fund selection. While many investors and financial publications gravitate toward funds with a recent hot past, like last year, investment professionals prefer to look at the consistency of long-term past performance. But is long-term past performance any better at predicting future mutual fund success? In developing this client presentation, my first question was, what became of the top performing funds of the past? I examined the performance of every mutual fund in 28 different categories during the 5-year period, 1988 to 1992, ranking the funds according to their total return for the period. I then ranked them for the following 5-year period, 1993 to 1997. I divided the fund performance into quartiles and focused on the top quartile performers of that first 5-year period. I then posed a question. How often did those top quartile funds of the first period deliver top quartile results in the second 5-year period? The answer? The top quartile funds of the first 5 years produced top quartile results in the second 5 years only 29% of the time. And 21% of the time, they delivered bottom quartile results. The top half, bottom half ratio was just 53-47. For the sake of curiosity, I decided to also see how the bottom quartile funds of that first survey made out. I was surprised to learn that 40% of the bottom quartile funds from the first 5-year period went on to deliver top quartile performance in the follow-up period. From that original survey, it appeared that past performance had all the predictability of a coin toss. As you can see, the results of my subsequent research through 2016. From the very first survey and every one thereafter through 2016, only 21% of top quartile performers in one period delivered top quartile results in the following period. But 35% of those top performers went on to deliver bottom quartile results in period number 2. I will conduct this research again at the end of this year, but I do not expect different results. If you accept what I just presented, that even long-term performance is no way to select mutual funds, you might ask, as I did, if long-term past performance cannot predict tomorrow's leading mutual funds, how the hell do you successfully select mutual funds for your clients? That is exactly what I asked myself back in 1998 when I finished exposing the failure of past performance. With single focus, I set out to see if successful funds had traits in common with one another. And I discovered that they do. Mutual funds have 11 traits in common that lead to successful fund selection. Beginning with the next session, I will reveal them to you. Thanks for watching. I look forward to having you join me for the next session entitled Trait Number 1, Assets Under Management. Until then, this is Jeff McTague reminding you, unless you can prove it, it's just your opinion.
Right here, right now,